So my name is Scott Talley, and we're fortunate to have Matt Brown with us today. Matt is with Encompass Lending, a mortgage company, member of Network in Action. We're grateful for that.
Great.
And Matt, we're going to talk a little bit today about first-time home buyers.
Okay.
It's a pretty big deal, isn't it, for people?
It is. It is. It's exciting. People are, being a first-time home buyer, they don't know the process at all, and they're really counting on me to hold their hand from start to finish, and so that's what really creates a great value for me.
Yeah, and how long have you been at it?
18 years.
Oh, wow. So you've seen a thing or two.
Seen a thing or two, saw the highs, saw the lows, come out of that, and so it's been exciting to where we're at now.
So what would you say to somebody that's thinking about buying a home and maybe they're 6 months to a year out? What would be some of the steps they would take to make sure they're ready, for the mortgage process?
Sure. So the first thing I always do is I take a look at their credit. That's paramount. That's the very first step in my process. So seeing where they're at, pulling credit, looking at what their scores are, calculating debt to income ratios to see exactly what they can qualify for. They may be ready right now and they may not be ready. So a lot of times, I may have to put them in touch with a credit repair type company to where we can get their scores up to where they're qualifiable, or we may need to pay some debt down in the next couple months. Just whatever that looks like. But we can see that pretty quick. Right when I pull their credit, I know exactly where they're at.
And so would you suggest, if you say you had a young couple that was looking at their first home, would you suggest doing that 6 months out, 9 months out, a year out? About how long?
Really, well, as soon as they can.
Okay.
Really. As soon as they start thinking about a home, we want to take a look at that, because some people, like I said, they're ready to go right now, and some people it can take 6 months to 9 months. We just don't know until we
I
look
have
at
heard
credit.
some horror stories where guys like you had a mortgage in the process, everything was going fine. Somebody goes out and buys a car a couple of days or a week before and changes the whole dynamic.
It really does. And we try to set those expectations right out of the gate. And we give them kind of a do's and don'ts list. Don't quit your job. Don't add debt, things like that. And so I think just trying to set the proper expectations for them going in, it helps out a lot. But that, even telling people, it can still, they forget or whatever. And it's like, oh man, and we can start scrambling. And sometimes people that are right on the border, a piece of furniture can push them over sometimes. If they go and charge up $1,000 and sometimes they can go buy a car and it doesn't affect them at all. So everybody's situation is a little different, but at all costs, we try not to, have that happen.
Yeah, interesting. So the first tip would be to make sure you get with you way ahead of time so you have as much time as you need to fix or repair things or get in place.
Correct.
I heard it once said where people go start shopping for a home and they don't really know what they qualify for, and it's sort of like walking in to buy a pizza and not knowing if you have any money in the wallet. Why would you do that, right?
That's exactly right. And a lot of times too, and they do just kind of the opposite, excuse me, they'll go and they'll talk to their realtor and they'll say, hey, we want to see this house, and this house. And the realtor, if they're smart, they'll stop them dead in their tracks and say, hey, look, before I put you in the backseat of my car and show you 40 houses, what can you afford?
Yeah.
What can you buy and where are you qualified? So then that's where I really rely on my realtor relationships to where they will get them to me as quick as possible, and then I'll take a look at their credit and go from that process. But yes.
So once they have an amount they can afford, you've worked with them on a down payment that they're going to need to have. What are the type things that a person can expect to have to provide you and your lenders to make sure that they're ready to go?
Sure. So we look, if they're W-2 employees, we don't need tax returns. So we only need W-2s. We need last 30-day pay stubs, last 60-day bank statements, and really if they have 401ks, we want to see those last quarterly statements. But it's pretty minimal. Literally 5 items gets it done, and then copy their ID.
And if they're an independent business owner, they got to jump through a little more.
Little bit more. If they're independent business owners, 1099. So 1099 we require 2 years tax returns, and we don't want to see declining income, and that's one of the tricky things in our business. Self-employed people can do really well. They write everything off.
Yeah. And
so we get their tax returns and they're like, hey, I make $150,000 a year. And then
no, you don't. You made 40.
Yeah, exactly. And they're trying to buy a $400,000 house on $40,000.
Yeah, I made that mistake when I was a younger entrepreneur. I wanted to save that 15% or whatever the amount was, So I'd save $10,000 or $15,000 on taxes on $100,000, and then I'd go to get some piece of equipment or something I needed. And they're like, no, you're not making that kind of money.
That's exactly right. So we struggle with that a little bit with self-employed people, but there are some what's called non-qualified mortgage type programs available outside of the Fannie Mae, Freddie Mac box. You can go to some of these non-QM lenders, they're portfolio lenders, and they'll have programs where we'll qualify somebody on 12 months or 24 months bank statements. That's what we're using as their income.
Right.
Yes, they're going to pay a higher interest rate. 8s, mid-8s, 9s. So they may pay another $300 a month for their mortgage per se, and call that $3,600 a year. That's much better than sending in the IRS 50 or 60 $1,000 in taxes.
Absolutely.
So they get that. And so we're doing some of those types of programs for self-employed.
And does your company help them do you sort of take the bull by the horns and sort of shop the different markets for them and then tell them, hey, here's one or two options, or how does that play out?
Yes, and that's what makes my company a little unique. I'm one of the owners of our company. We've been in business now 11 years. It'll be 11 years in May. We started this mortgage company in the worst possible time in '08 when everything was falling out due to the crisis. And so what makes us unique is that we're not only a broker, but we're also a banker. We're a broker in that we're signed up with 21 different lenders. So that gives us the flexibility to go out and search multiple lenders for the lowest rates and fees. And then we're a banker in that we fund the loan in our own name with our own monies, and then we sell the loan a couple days after closing. And somebody will take over and they'll service the loan for the next 15, 20, 30 years.
Gotcha.
So that's what makes us unique, is that we're not just one entity. Like if you go to a bank, you're going to get whatever the rate is for that bank for that particular day. And that they may or may not be competitive on that day. So we can go and shop multiple lenders for them.
Okay, makes sense. And so what are some of the other pitfalls you might talk about for first-time homeowners, or what are the things they need to look for? What are the things they need to prepare to give you? Anything else you can think of?
No, I mean, that's pretty straightforward. I mean, it really...
Sounds a little more simple than it was 15
it really
years
is.
ago.
No, it is.
Yeah.
It's pretty straightforward because right now, I mean, it's a hard line in the sand. You either qualify or you don't. I mean, there's no real flexibilities in these programs, and the lenders want what they want, and you either have it or you don't. And everything has to meet ratios, debt-to-income ratios. And so typically, I would say 70% of our business is conventional lending, which is 5% down, 10% down. That's your Fannie Mae, Freddie Mac, just plain vanilla lending. And then we've got FHA, which is probably another 30%. And then we do VA, veterans. And so the max conventional loan limit right now is $484,350. So if you go over that loan amount, you're now moving into jumbo territory.
Okay.
So we do jumbo loans as well.
I don't guess the first-time home buyer typically is doing it so often. Yeah.
Not typically.
So obviously the mortgage crisis a few years ago scared the heck out of the country and made a lot of changes, and the government jumped in with some new regulations. What kind of things happened after that crisis?
Really did. I mean, what really happened from that crisis is what subprime lending went away. So typically in the past, you had people that had credit scores below a 600 and wouldn't have to put any monies down and had no monies in the bank on the day of closing. That's where that regulation really came in, is that they said, okay, that's subprime lending, that's all gone.
Yeah.
Now, if you want to do a loan, you need to have a 620 credit score or greater for conventional lending. And now, by the way, you need to have this debt-to-income ratio cannot exceed 45%. They have since expanded that ratio to 49.99. But that's one of the things that they've really come in and they've cleaned that up. So, I mean, again, you either qualify or you don't. There's no flexibility type programs.
So really, at the end of the day, a person needs to keep their debt to a minimum.
Sure.
They need to get their income wherever they can possibly get it, and then they have a great credit score.
Sure. Yeah. I mean, and really not, a great credit score is anything, we think a great credit score is anything 680, 700 and above. But let me tell you kind of what the ratio is entailed.
Sure.
There's a top ratio and a bottom ratio. The top ratio is your housing ratio. The housing ratio is the projected house payment that you're going to have on the new house divided into your gross monthly income.
And you suggest where a person ends up where on that?
That one about 41%.
So a person should plan to have about 41% of their income be based on their housing.
That's correct.
Monthly.
And we do everything by gross. So that's before taxes. So that's the top number is 41%. That bottom number, 45 to 49.99, that's your projected house payment. Okay. Plus anything that's showing up on your credit report as a minimum payment. We don't mind that you've got $100,000 in student loans, but if you're obligated to them by $250, that's all we count as that $250.
Okay, gotcha.
So $250 there, $500 credit, a car payment, whatever. So you add up those liabilities plus your projected house payment on the new house. Yep. Add that together and divide into your gross monthly income, creates that bottom ratio. That's called your total expense ratio.
So you're really going to be there for the customer from maybe 6 to 8, 9 months, a year ahead of time, all the way through closing. So once they've provided you these documents and you go to work getting their loan approved and they've decided on a loan program, you set the loan up. And what happens at closing, or what role do you guys play at closing?
So typically what I do, and again, where I differentiate myself from a lot of my competitors, is that I'm with my borrowers from start to finish. Yep. I mean, literally, I'm hand-holding the entire time. I have a team that works with me. And so this process of closing takes about 30 days. And we average around 24 to 30 days, depending upon how easy the underwrite is.
So once they've gotten you the documents, you
Correct.
can typically get them to closing in about a month.
That's correct. I mean, pretty much.
Yeah.
And then once we get them really, and then I go to all my closings, which is really unique.
Nice. Yeah.
It's really unique. And I don't do a whole lot while I'm there.
Yeah, it's really intimidating the first time. You're sitting there and a stack of documents this big, and some lady you don't know. It's like going to the doctor the first time there, asking you to take a shirt off, and you're like, who is this? But they're
exactly.
Yeah, you're signing all these documents. Yeah.
It's the same thing.
Basically, I'm going to take ownership of that home when I leave the closing. You're going to get funded because of the documents that have been signed.
They're
going to take payment of the down payment and the other necessary fees, and they get some kind of estimate right at closing or prior to closing.
They do. It's called a closing disclosure. So one of the regulations that changed is that we have to provide that closing disclosure 3 days prior to closing.
Okay.
And it's usually pretty spot on. There might be some minor changes, but there's an initial 3-day disclosure.
Oh, yeah, that's very different.
It is very different.
I haven't closed on a home in about 14, 15 years. Yeah.
But what keeps that from happening is when you get to closing and a mortgage broker might have told you, hey, you need $10,000 at closing. Then you get there and you need $14,000. It's like, what happened? And then you're sitting at the table and you either sign or you don't get the house, or
it's a nightmare.
It's a nightmare.
Spend just a second talking about PPI, what that means to the buyer, the insurance that on the
PMI?
equity, PMI, I'm sorry, on the equity. Yeah, talk about that a second.
Yeah, so basically anytime if you can't put on a conventional loan, any down payment less than 20% requires PMI, private mortgage insurance. That protects the lender in case you default on the loan.
Gotcha.
So, the more, if you have 20%, then you don't have to pay PMI. So the better your credit score, the lower that PMI factor is each month.
Yeah.
So if you have a good credit score, you're not as much of a risk.
Yeah.
And so, but there's ways to finance around PMI. If people have really good credit, say they can put 5% down, you're either going to do a 95% loan with PMI, or we can look at doing what's called a piggyback loan that encompasses two liens, an 80-15-5 and 80-10-10. So we can finance around PMI. And a lot of times that combined payment of an 80 and a 15, first and second lien, is a lower payment than the 95% loan with PMI.
Yeah.
So we want to look at all factors.
One of my questions I was going to ask is sort of how do you differentiate yourself? But I hear it in this conversation. It's really about service at the end of the day.
It is.
I'm not to knock any of the big banks, but it's not unlikely that a Wells Fargo or Chase or Bank of America is going to travel with you to a closing,
right? And
probably not going to work with you 8 to 9, 10 months ahead of time to make sure you're ready to go,
right? And and I take phone calls. If I need to talk to somebody at 8:30 at night and they can't get it off their mind, I'm available in the evenings, on the weekends, and so really again, there's thousands of guys like me that can do mortgage loans. I mean, the loans are what they are.
Right.
Where I differentiate myself is through service, and you hear that through everybody, but I really take it to another level.
That's
I try
awesome.
to.
And since you guys have started, y'all, how do you market the company? You obviously do some networking.
Yeah, do a lot of networking. I mean, I'm all over Facebook, LinkedIn, Instagram. I participate in a lot of happy hours with title companies, a lot of different networking functions. So I'm out and about. I'm part of Network in Action.
How's that been for you? You've been in a couple of years, or?
Yeah, this is my second year. So
awesome.
I'm 14 months. So I'm going into my second year
awesome.
here, and it's been great. I've met one of the realtors in our group, Rob Rule. He's a phenomenal realtor. So he and I have been partnering back and forth, and then we've got a lady in our group who does a lot of signs and banners and a lot of that kinds of stuff. So she's done a lot of banners for me and yard signs for open houses, and so trying to do whatever I can to kind of reciprocate business within that organization.
Right.
Yeah.
Well, listen, we really appreciate you coming in today.
You're welcome.
It's been very educational for, I'm sure, first-time home buyers to be able to look this up on the internet and get a little education, and hopefully they'll reach out to you. So thanks for coming in.
Thank you for the questions.
Good to meet you.
I appreciate it. Nice meeting you too.